Call the meeting to order. Good afternoon, everyone. Thanks for joining. I think before we start, I need to read the land acknowledgement, and then we'll do roll call. Okay. The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lisjon. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this Indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home. So I think at this point we can move to the roll call.
All right. Committee Member Carr?
Here.
Committee Member Penzar? Yeah.
They cut out on me. Sorry. I'm here.
Okay. Committee Member Papalia?
Here.
Committee Member Priven?
Here.
Ooh, Vice Chair Priven. And Chair Trainer.
Here.
It's going to take me a minute.
All right. Okay, so moving along the agenda, there was an item for approval of minutes, and I had in my notes that we did not approve the May meeting minutes at our last regular meeting. I'm not sure, are we going to do that at our next meeting or?
Yeah, I have that on my list of things to do to get all of the minutes that we have missed and put them on your next regular meeting schedule.
Okay, and I guess, does that also mean we're supposed to take meeting minutes of this meeting as well?
And they will, yeah. For the committees, they are just simply action minutes, and it is just me going through and saying this person motioned, this person seconded, and here's what the vote was.
Okay. All right. Okay, so we have no approval of minutes for this particular meeting, this being special meeting. The next item on the agenda is number 3, announcements, where we can have staff and committee member announcements of things that are not, that we're not going to be talking about on the agenda. Is there any announcement that anybody would like to make?
I have one, actually. At the last meeting, there was an agenda item to go over the ballot initiatives that the council reviewed this year, but it has been decided that I should just say council approved the EMS tax to go on the ballot, but they did not move forward either of the other two, the business license tax update or the commercial vacancy tax. And all of the information for all election materials is online. If you have questions about the two that were not passed, all of that information is also available on prior council agendas. And if anyone has any questions, they can reach out to me and I can direct them to the correct places.
Okay. All right. So that takes us to agenda item number 4, which is public comment. Is there any public comment?
I don't see any hands raised.
Oh, all right. Great. So item number 5 would be staff presentations. There are none for this meeting. And so then that takes us to item 6. For discussion and possible action on matters related there are actually 4 points in item 6. So 6.1 is investment management proposals. And I guess I'm going to defer to you on this, Heather.
Sure. So the city put out a request for proposals for investment management services, and we received 9 responses. In reviewing those responses, we ranked them based on price and experience with municipalities and a number of other things. And it has been decided that we would like to bring 4 firms in to interview. This should take probably either an entire morning or an entire afternoon. There will be staff on the interview panel, and we were hoping that we could get 2 financial advisory committee members to sit on the interview panel as well to weigh in on the person or the firm that is selected.
All right. So is this a thing where we nominate people or people volunteer?
Both.
Okay. Is anybody interested in participating on this committee that would like to volunteer?
I'd be
I'd be happy to do that, yeah.
Okay, so it looks like Vice Chair Priven and Member Kerr. Did I also see that you raised your hand or Member Panzer? No, okay. All right, so
sorry, just in case the dates don't work, should we get a backup or?
sure, I could be a backup. Depending on when we're looking at dates. So for now, do we need to have a motion on this, or is this just okay? So then I'll move that that we nominate Vice Chair Priven and Member Kerr to be the 2 committee members that would serve on the investment subcommittee panel. Is there a second?
Second.
Okay, and committee member Kerr?
Just to, maybe we could put member Trainer in as an alternate on that same motion so that we can do it in one flow. Go.
Mhm.
Is that okay with everybody? So I vote yes.
Yes,
Okay.
that's fine. I second that friendly amendment.
Perfect. And committee member Pansar
Yes.
and committee member Papalia
Yes.
and Vice Chair Priven
Yes.
and Chair Trainer.
Yes.
Motion passes.
Okay. All right. So Heather, you'll just keep everyone apprised about what dates we're looking at for that.
Yeah, I'll reach out and see if there are dates that definitely don't work for people, and then we'll go from there.
Okay.
I'd like to do it within the next couple of weeks so that we can get that ball rolling.
Okay. All right.
Can we have kind of a general overview of what was in the request for proposals, or the kind of, you said there were 4 people who responded that you picked. Is there?
Yep.
So
So
what are the
we're-
kind of things you're looking for in particular?
the request for proposal was fairly expansive. The request itself was probably like 12 pages long, and we got 9 responses. We first ranked it by price, and then we went through all of the responses and we looked at what firms worked with municipalities in California already, what the firm's rate of return on average was. We looked at their experience with, what were some of the other things that we looked at? We looked at their experience with updating and just in general with California investment policy laws and rules and all of that. And there was one there, whether they had any complaints filed against them, things like that.
Right, great. So I think that wraps up item 6-1. So now we'll move on to 6-2, which is the work plan item covering unfunded pension liabilities.
Oh, sorry, did we have any public comment on, did anyone want to do public comment on the previous item? No hands. Now we can move on.
Okay. All right. So moving on. So this was the item that we started to discuss near the end of the last regular meeting in July and kind of had to shut it down so that we could vacate the Zoom room for the next meeting that was coming up. So I had presented a memo, and I'm thinking maybe I should put this back on the screen again so we can reorient ourselves to this and kind of finish the discussion on this. So I'm going to go ahead and share my screen. And it's a little bigger here. All right, so this was the memo that Mark and I put together to talk about the unfunded pension liability. And I won't go over every last item of this. We can kind of make that part of the discussion, but basically the memo goes into detail about what the unfunded accrued liability is, what are the factors that are causing it to increase, and some items around that. So we were working with actuarial valuation reports from CalPERS that were from the 6/30/20 plan year. So these are already 2 years behind, right? And we know, for example, so there are these 9 pension plans that the City of Albany has. And we have updated reporting on this one here, the single employer plan, which is the plan that was closed back in 1971. And that one showed a pretty dramatic increase in the unfunded accrued liability as of June 30th, 21. I think I've got that in here somewhere. I think it's something like, it's up to, I want to say $10 million. And it was $6.7 million unfunded accrued liability as of 6/30/20. So these unfunded accrued liabilities are increasing over time. This table, I was looking at this again today because we received an email. I think the entire committee received an email from a community member that was proposing that we take a look at a report that came out of UC Berkeley, Haas. I'm not sure if it was School of Business or it must have been School of Business. It was an interesting report talking about funding implications of government pension plans and talking about funded ratios. And one of the numbers that was presented in that report was that the national average funding ratio is about 70%. And we give the funded ratio here on these plans, and our average is 69.4%, although I suspect that number has gone down now because we know that the single employer unfunded accrued liability has gone up to closer to $10 million. So this one plan is in a much lower funded ratio, which is basically, I believe, the assets. I can't remember. I don't want to say it wrong. Mark, you might be able to help me on this. I think it's the pool of assets as a percentage of the accrued liability. So this 4 over this 11 would be about 42%. Okay. And national average is about 70%. So the single employer plan is definitely sort of an outlier among our other plans in terms of its funding percentage. The funding percentage of the newer plans, which would be the PEPRA plans, tends to be a lot higher, 87.5, 87.4, 91% for these different PEPRA plans. And then the older plans look like they tend to kind of hew closer into that 70s range. So 73% for the police tier 1, about 71% for fire tier 1, 88% fire tier 2, miscellaneous tier 1 was 69%, miscellaneous tier 2, 87%. So we're sort of a little bit all over the place, but the general trend being that the newer PEPRA pension plans have a higher funding percentage or funding ratio than the other plans. So that's sort of an overview of where we are. This number was 43 million as of the 6/30/20 actuarial valuations, and we don't have a current number where we are. Then some other interesting, another interesting table is what's happened to the UAL over time. So this 43 million here in the 6/30/20 column is the most recent number available. And then these numbers down here just are looking at the percentage increase each year. There were some pretty huge percentage increases back in these early years. I can tell you that from 2016, the reason why the unfunded liability increased so much was the amortization period was reduced from 30 years down to 20 years. And also just a comment from that article from Haas, which I don't have here, but which was presented. And Heather, does that become part of the public record, that article that was submitted? So.
Yeah, we attached the memo as a public comment, so.
Okay, so there was public comment. One of the things that I found interesting from that, and I don't have that in this memo because I just received this about a week ago, was the amortization period was reduced by, I guess it was by CalPERS, was reduced from 30 years to 20 years for the unfunded accrued liability. And the author of this other article, I'll just flash it here briefly, it's called Funding Public Pensions. This is attached somewhere to the agenda, policy brief from someone named Tom Skoros from the Haas Institute over at UC Berkeley. That article talks about the wisdom of shortening amortization periods for unfunded accrued liabilities, and makes what I think is a pretty good argument that governments are different from for-profit corporations in that a government is an ongoing entity. It doesn't have the same risk of a for-profit company of it may not be here 10 years from now. And for-profit corporations, the pension accounting for them is much more aligned towards they need to make sure they're fully funded because they might not be here in 5 years, and that liability should not be transferred to the general public. So there's a little bit of that article is making an argument that there's a bit of a different standard for governments because governments are perpetual entities, and there's not a worry about a city or a state government as a going concern the way there might be with a for-profit company. So it did make me wonder, why did CalPERS change the amortization period from 30 years to 20 years? Because that had a huge impact on the UAL, and it caused it to go up by, I think, 56%, trying to find my table. Where'd it go here? Oh, wrong one. 59%. It went up in 2016 when the amortization was shortened from 30 years to 20 years. So that's an interesting question as to why they did that. I guess there was a concern about allowing a significant unfunded liability to just exist in perpetuity. And I guess there was a desire to cure that unfunded liability on a quicker time frame. But it does obviously have a huge impact on the liability, because if you're dividing the unfunded amount over 20 years instead of over 30 years, the amount that you have to pay each year to fund that goes up quite a bit. So that was one of the reasons why the pension unfunded accrued liability jumped so much. And that was back in 2016. One of the other significant factors is the discount rate. It is currently at 7%, and CalPERS is actually considering decreasing this rate further because there is some thought that a 7% annual investment return over future periods may just be too optimistic. But if the discount rate is decreased, that will also result in an increase in the unfunded accrued liability. The actual performance of the plan investment portfolio, so the CalPERS performance will impact the unfunded accrued liability. So if they're targeting 7% and they're only hitting 5%, or in the case of the most recent fiscal period, I think it was negative 6% for June 30th, 2022, that also will add to the unfunded accrued liability because they're not generating the investment return that was expected in the calculations. So the concerns for us as a city are these payments are made from the general fund, and the general fund budget is kind of budgeting, it's budgeting at a deficit. And so the revenue for the general fund is expected to increase at roughly a 3% flat rate. The expense is expected to increase at a slightly higher rate, so between 3 to 4% annually. But the pension payments, including the unfunded component of that, will be increasing at a much higher rate. So I did a chart to sort of show what we're expecting. So the UAL payment chart is this blue line. And that's going up way faster than revenue is increasing, and also faster than other expenses. Otherwise, revenue and expenses are running roughly in line with each other. So that's not the problem, but this gap in between how much the UAL payment will increase versus how much the revenues will increase is our problem. So given that we are budgeting a deficit to begin with, having this big unfunded payment that we're responsible for making just makes it that much harder. It's going to grow the deficits. So in terms of solutions, there are, I think it will be a multi-pronged solution set. So we're going to talk about additional general fund revenue sources later in this meeting. And if we can increase revenue that is for the general fund as opposed to revenue that's reserved for other special funds, obviously that is helpful, whereas special revenue is not as helpful to this particular aspect. Pension bonding is another possibility. And the idea with pension bonding would be if the city were able to issue bonds at a lower interest rate than the expected return of the pension fund, then that could be a good, that could be a way to solve the problem. I have a lot of reservations about using pension bonds to refinance the debt, which we could talk about maybe more in discussion, but we would be leveraging ourselves. And if the proceeds from the bonds then lost money, we still have to pay back the bonds at the full amount. And so it just increases our leverage and our risk. And then the other possibility of addressing this budget deficit that we'll be facing in the general fund is to look at reducing general fund expenditures in some way. So one possible solution is to do more of a research project looking at core services provided by the city and determining if there are things that are in excess of the core services provided by the city that could potentially be, those expenses could potentially be reduced. So that's the overview summary of this. And so now I guess that is the time for comments and discussion on this. Next steps.
Firstly, can you, on your graph, Heather, can you let us know what the gap in 2024 and 2025, and when we say 2024, we're talking about fiscal year 2023-24, right? Would be next July 1st to the following year, June 30th. Okay. So what that gap is just a gap. Is there a dollar amount that you could approximate that that we would need to think about
So
for
the projected deficit for, I can just show, let's see here. I'm just going to put a couple numbers up on the screen for a minute. So these are the projections for the years, and I'm assuming this means fiscal year 22-23. So income projected at a 3% increase would be about 26 million. Expenses, excluding the pension UAL payment, would be about 24.8 million. The pension UAL payment is 2.9, so the projected deficit would be 1.6. And then you can see how that goes up
okay.
as the years go on. So it's, you know, it's going up each year, and the UAL payment, you know, is going up each year by more than the rate of increase of the other expenses.
And that table is not part of this report.
That was what I based the graph on, that
Got it.
table.
I think it would be helpful to have that attached to the report, because the graph is the numbers would be helpful. Okay.
So, you know, I mean, the problem is we're looking at these big deficits that are, I don't want to say they're caused by the pension UAL payment. The expenses are what they are, but the pension UAL payments are, in every case, they're more than the deficit, I guess. So in other words, if we didn't have to make this large pension UAL payment, we wouldn't have a deficit. And the deficit gets worse every year because we're basically projecting 3 or 4% increases in expenses, but the UAL increase goes up by a lot more than that every year. So eventually this would put us, you know, with deficits in, you know, over $3 million in 2028 and some of the years after that. And then it will start to fall again at some point once we've kind of hit the high point of the UAL payments, because of the 20-year amortization, they really rise quite a bit as you get towards the end of that amortization period. And the end of the 20 years, would that be 2036, Heather, because we switched over in 16?
For the first year, yes, but each year is amortized on its own. So each year has a 20. So yes.
Yeah. So I guess the whole idea behind doing this is to sort of call attention to, and I'll add a data table as like an appendix to this report that projects what the projected deficit will be for each of these next 10 years. But it's projected to grow, obviously, to over $3 million a year. So, you know, given that, I think that it's a good idea for us to draw more attention to this, to the council. I did learn that the council has not yet allocated the fiscal 22 surplus. Correct me if I'm saying this wrong, Heather. But that the council has some latitude with regard to how much of the surplus is allocated to pension, how much is allocated to, you know, capital, the capital reserve fund, other things like that. And I also think it's my understanding that roughly from the last year, fiscal 20, the fiscal 21 surplus was allocated half to paying down on the unfunded accrued liability for the pension, and half was allocated to as a reserve against the budgeted general fund deficit for the fiscal 22 year. Is that right?
I don't know if it's necessarily half. They did do a $500,000 payment to pay down pensions, so that in total, in fiscal year 22, which just ended, the city made a total of $1 million worth of an additional pension payment to the CalPERS pension plan.
So there was 500,000 that was allocated from fiscal 21, and what was the other 500,000 from?
There was, I don't remember the exact amount, but originally staff had suggested that it be allocated to reserve funds. The Financial Advisory Committee had suggested that it go towards pension. I did another review before I brought it back to council, and with the projected deficits and the increasing expenses, in order for the city to continue to meet its 25% fund balance obligation, I had suggested that we just leave it until the fiscal year 22 audit comes back so we can see where we are then.
Okay. So we do have that advisory capability this year, and one of the things we're going to talk about later is the work plan and the reporting that we'll do on the work plan. But given that there is anticipated to be a surplus, the Financial Advisory Committee can recommend to council some certain amount of funding that could be allocated as additional payments against the unfunded liability from the fiscal 22 surplus. And yeah, yes, please, Judy.
I wanted to make a comment and had a question too, but I wanted to make sure that I wasn't interrupting anybody's thinking. So should I just go ahead and?
Yes.
So thank you, Member Priven and Chair Trainer. This is a really good report, and it explains it simply. And thanks, Member Papalia, as well, for recommending that it get footnoted with the actual data points, because that is helpful. But in the possible solutions, there are three, and they're fairly self-evident. You know, you spend more, you make more, or you do something else. But there's a further question that I have that I just don't know the answer to, and that's how much control does the city have over where these individual funds are broken out? In other words, could you blend tier 1 and tier 2, or fire 1 and police 1 into the same investment package and thereby increase the revenues on those? I just don't know how these things are structured, and that may be a question that is for Heather or possibly for legal counsel. But there may be more solutions beyond the increasing revenues or decreasing expenses strategy that we're proposing. It's a huge problem, and it's going to require some creative thinking. And I think if we knew where the guardrails were, what we can do and what we can't do with regards to these various pension funds. And believe me, I am not proposing that we eliminate pension funds because I'm a pensioner myself. So I don't want that to be the implication of what I'm saying, but what are the rules and what can we do and how much flexibility and leverage do we have to improve the return on these investments is my basic question. And how do we find that out? So thank you. Those are my comments.
I can address that if you'd like.
Yes.
Sure.
CalPERS, as far as I am concerned, is a black hole. You give them money and they do with it what they will. They do have, advisory boards and, individual cities as well as pensioners as well as employees sit on those advisory boards, and they help craft all of the, policies and that CalPERS follows, including, decreasing the amortization schedule, including reducing the discount rate, including, all of those things that come into this. So while the city does not have individual control, there are means to address, in general. Does that mean that what we suggest or what we ask for is going to happen? Not necessarily, but that's how it works. Now that is very specifically for the CalPERS plan. The chart that Chair Trainer had up on the bottom said a single employer plan. That is the closed police and fire pension plan that the city has, that the city is fully responsible for. It is part of the city's charter. The reason that funding level has decreased over the years is because I don't know how to say, I'm going to try to say this delicately. The plan closed to new participants in 1970 something.
71, I think.
Yeah. So the people that are in there are all in their late 70s, early 80s. They are not expected to live that long. So the amortization schedule for that plan went from like 10 to 15 years to 5 years. And there are decreasing number of participants in there every year. So I think right now there's 16 participants in that plan. Because of the decrease in the amortization schedule, the required annual payment increased to the point where it was almost equal to just paying out of pocket every year. So the idea has been that we slowly decrease the amount of additional payment that we make to that plan and slowly increase the amount that we're just paying out of pocket every year from the pension override tax. And so you will see that funding level for the single employer plan go down in future years. I do not think that that is a good, our main concern is our CalPERS plans, not the closed plan. So I just wanted to throw that out there.
Okay. Is it safe to say that we're also not assessed that 7% charge then on our unfunded balance?
Correct. That is 100% something that is the city runs. The city is fiduciary for the assets for that plan. We have the pension board, the police and fire pension board has a presentation from the investment manager for the pension assets every quarter. Those are public meetings. And so we do have more control over those funds. We can suggest changes in asset allocations. The funds, go up and down with the market. They have, performed, fairly average well in, comparatively. So we have much more control over that plan.
Vice Chair Priven, you had a comment?
Yeah, thank you. A couple comments. So first of all, to Member Kerr's question, yeah, so I think that the money that goes into CalPERS, we don't have any much control over how it's invested. But if we were to, increase revenue or whatever the things were that we're talking about, we have an option. We can fork all that money over to CalPERS and hope that CalPERS invests it and gets 7% or whatever, or tying into one of the earlier agenda items, keep the money off to the side, dedicate it, earmark it for pensions. But if we thought that for whatever reason, our own investments could do better than CalPERS, then that would be an option. And maybe that would be something to explore or to ask the potential investment advisors about, in the interviews and stuff like that. A couple other things. So Chair Trainer, I really liked your summary. I agree with everything you said. One thing I just want to highlight is, I don't think this is the city's fault. I know one of the questions is like, well, how did we get here? How did this possible happen? I feel like the rules of the road kept changing. I think the city, as far as I can tell, paid what CalPERS said needed to be paid for the pensions every year, and sometimes even more. But CalPERS at some point said, oh, we're changing how long you have to pay things back, or, oh, we're realizing that our assumption regarding how much investment income we're going to earn is different than what we're doing. So we're going to change that. And so now you're not funded, you're underwater. So I just want that to be clear. At least that's how I conceptualize it to this committee and and when we talk to the council and to anyone you communicate with, and any resident or whoever about why we have this unfunded liability. As far as I can tell, again, I think the city did what CalPERS asked them to do. The other thing I'll just add is and to that point of the rules of the road being changed over time, I think that as we hone in on solution and say, here's the nut we need to crack, here's the plan, I think we need to assume that the rules are going to continue to change, and that we're not just going to assume 7% and that's the end of the game. Like, we should be more conservative. This is my opinion, that whether CalPERS says we need to fund less than 7%, we need to assume less than 7% or not, I think for our own good, we need to use conservative assumptions when we're trying to figure out how to solve this problem. One more thing, and then the last thing is, I'm very frustrated at how old all this information is. I just checked yesterday, and the CalPERS data for Albany is still 6/30. It's still as of over 2 years ago. It's 6/30, 2020, and so I mean we've had audits. I mean we've prepared financials, and I guess we're doing financials now as of the end of 6/30/22. So somebody must be able to access this data on a more timely basis than we can as the public going on the CalPERS website. So I'm hoping that we can get more current information again as we really hone in on what we're going to do about it. Yes.
So I was provided the 21 actuarial evaluations 2, maybe 3 weeks ago at this point. I don't want to share them because that year had an 18% investment return. So they look really, really good. And that's not going to last. So I can provide them. But like you were saying with, trying to be more conservative, I will suggest, and I mean, you guys can support or whatever, that regardless of the drop in the required contribution based on the 18% investment return, I would suggest that we continue to budget for a slight increase and either put that aside to offset future increases or make an additional payment next year. So they are available. I can provide them. They paint a very rosy picture that will not continue.
Because we know they gave back about 6% of those returns in the year that just ended.
Right. So if you take 18 and minus 6, you're going to get 12, which is 6% per year, which is lower than the 7 that was the target. So
I know we've briefly discussed this topic of creating a separate trust account that would accept pension contributions, but that would remain under the control of the city, as opposed to just putting those funds into CalPERS. And I know, Heather, your comments have been in the past that there are a lot of expenses and uncertainties associated with that. Plus, we'd have to have an investment manager managing those funds and try to get better than the CalPERS amount. I like that idea, if only for the fact that, as Mark just suggested, the rules are just changing constantly. And even if the rules stay the same, if there's a big negative return, then the rules didn't change, but the unfunded liability still increased. And if there were a way for us to set aside funds that we could use to smooth the required payments that we have to make into the plan, then perhaps that could be used as a way to just try to avoid some of the volatility of, the required payment next year is 3 million, and then it goes down to 1 million, and then it goes up to 4 the year after that. So I'd like to talk more about that idea of establishing a trust that we would retain control over, and we could use it to smooth out our actual payment expense each year.
Do you want me to comment, or?
I know you're not a super fan of this, but I want to hear more. I would like for you to elaborate a little bit more about that idea.
So I am not against setting aside funds for this purpose. My concern is specifically creating a 115 trust that locks the money away for this purpose. Mm-hmm. Again, the cost and the fact that CalPERS charges 7% on the unfunded liability and, all of those things. So again, not against setting the money aside. I have some concerns over the expense of creating that trust, where we're not really sure how much we're going to be able to put in it, and we don't know how long the money will be in it if we're just going to pay it off. So that is where my concern is.
Mm-hmm. And I have a comment about that notion too, and it's based on a sort of imagining what would happen if cities much larger than Albany decided to use the same strategy. If LA, for example, or San Francisco, or any of the large cities in the state decided that they were equally going to sort of work outside the black hole, as you described it, of CalPERS, the market volatility that would generate is pretty significant, and I'm pretty sure that CalPERS would shut that door quickly if it became the sort of strategy for coping, which isn't helpful, but it does sort of put it in perspective about, we're only a tiny little city. But if everybody did that, CalPERS would fail. So that wouldn't serve anybody's purpose.
CalPERS is still going to get the required payment. There's no way around making that. But this would just be excess funds that we would consider allocating. So similar to how we made an additional $1 million payment last year above what the required payment. Mm-hmm. So it's really more sort of establishing a reserve account that we can use to put into CalPERS when we decide to, or we could use it potentially when that required payment rises to going to go as high as almost $5 million a year in 2030, right? Something like that. So it's really an exponential increase. And if we wanted to try to blunt some of the effect of the increase, we could start setting aside a little bit now. And
I appreciate the clarification. Thanks. Yeah, that's much.
Because you can give CalPERS the money, they can change the rules on you, and you're still in the same position you were in before you spent all that money. And if we had it in our own sort of a reserve fund, I don't know maybe a Section 115 trust isn't the way to go because it takes away the flexibility to then reallocate it for capital needs or something. But I guess I'm interested in exploring, is there some way we could have some sort of a reserve, I don't know what's the right term for it, that gives the city the flexibility. The idea would be it would, you know, we would use it to pay down those, make those required pension payments, the UAL payments, but it would help us, you know, I guess take some of the toll off of the, you know, the annual amounts that we have to make, especially in the years when it really goes up. So I don't know how do we even do that? Is that just sort of a designated fund balance that would sort of be kept with other funds that would be under management of the new investment management firm?
I would set it up similar to our other reserve funds where they'd be pooled investments, but we would track which portion of the pool was for the pension.
Mm-hmm.
And all that's required is the council to vote on doing that.
So the idea there would be we still have to make our required UAL payments, but to the extent that we had any extra, instead of giving it to CalPERS, we say, well, we want to retain control over what is done with those assets, and we think we can do at least as well as CalPERS in terms of our investments. If we're not going to do as well as 7%, then we're better off just giving it to CalPERS. Okay. So having said all this, I guess the questions are, we do have the option to make a recommendation to council about how to allocate the fiscal 22 surplus. And, you know, are we in favor of saying, let's go ahead and make an extra pension payment? Or do we want to look into the idea of setting up a reserve fund, or, you know, what are your inclinations on this?
I think there's some hands up.
Okay, let's go to member Papalia first.
Okay. Well, first of all, I would like this report to be presented to the council in its entirety with the numbers that the number sheet that we discussed. Mm-hmm. And I recall that when in one of our last meetings, when we were discussing these additional payments, I thought Heather said that she was going to come up with some kind of plan by the end of the year. And our next meeting is November, beginning of November. So, is that still, are we still on track for that, Heather?
I'm not sure exactly what you're referring to. I have a lot of plans.
Okay, well, all right. So when we proposed this idea of putting an additional $1 million towards the unfunded pension liability, one of the purposes of that was to pay it down and also to save the 7%. As an immediate return, in a sense, on that pay down. That was bandied up. We were discussing that, and now I'm trying to remember whether this was something that you said in our meeting or at the city council presentation, where, you know, what is the finance director's plan for dealing with the pension? I mean, that was so that was one question that I had. I thought that so I've been remembering this, that there was going to be something going to be put together for us at the end of the year. The second thing I'd like to understand is the 18% return. I'd like to know if anyone can describe where CalPERS is investing this money. And that very big return that you didn't want to share with us, which I think we should share with us, with the caveat to explain, why we can't depend on that. Was that part of the stock market run up? That was, so where does this? I wish I knew where to invest money where I could get a 7% return, even, that's, I assume, is very safe. It's a low risk 7% return. So can we get some kind of understanding as where CalPERS is investing the money, or is that a secret too?
That is a CalPERS thing. I have no control over that. I attend webinars that often talk about, their investment strategies and everything. CalPERS is a long-term investment strategy. They do have very risky investments in order to make those returns. And again, that 18% return was as of June 30th, 2021. So that is an old return. The June 30th, 2022 return was -6%. And it's not that I wasn't going to share it. It's just that it is, we don't often, with you guys, it is on the work plan to share the pension information. It's something that's included in all of the financial audits, but it's not necessarily something that is brought up on its own very often.
And
can I just add something? Oh,
yeah.
Sorry.
Yeah, please go ahead, Mark.
I was just going to add that I think they look at investments a little bit differently in terms of risk. So when you think about a pension liability being stream of payments being 30 years, 40 years, 50 years, they look at what is the stock market return over 30 years or over 40 years. So they would consider investing in the stock market not to be that risky because over a long period of time, the return is much higher than in bonds. So they are and I think some of their publications show like what percent stock or whatever. We can't see what exactly stocks and whatever, but you can see kind of their asset allocation, and it is very it's weighted towards stocks and things like that are designed to get a higher return over a long period of time. The other thing I'll just say, I think maybe definitely in the back of my mind of why I was thinking about, maybe keeping some money, not every time you want to pay down the unfunded liability, putting it all in CalPERS, but maybe having another fund that could accrue to do that. So I'll speak for myself, but I know that Chair Trainer was looking at the same literature when we were researching this, is that there were some articles that were highly critical of CalPERS in relation to other pension funds in terms of what kind of returns over time CalPERS has gotten versus other ones across the country. And so, I'll just admit it's just, a couple of articles and, of course you can't believe everything you read, but I do have a little bit of, wondering in the back of my head, is really CalPERS the best place to get the best return? If that helps kind of filling in the thought process.
That's very helpful. And then, so I heard these two numbers, the 18%, and then you said give back of 6%. And, that to me, I got real confused and felt like there was something, what is it? So am I understanding then that now if the return was 18% in 1 year and -6 the next year, that sounds like an average. So you subtract 6 from 18 and you get 12.
It's 12 over 2 years, so it's 6 per year.
All right, so that's pretty steady for the 2 year.
But less than the 7% that they are targeting.
But that's why, that's now that I understand.
And
I saw the 8 and the give back, it's like, you're seeing this, but we want to see the average. And now I understand. Now you've explained where they're putting the money. So thank you.
one of the complicating factors is that market returns don't just go a nice 7% gain each year, right? There's the volatility, and some years are way up and some are way down. It's almost never exactly what's expected. But one thing with a really shortened amortization period of paying back the UAL of 20 years is if you miss your 7% goal in year one and you're short, then you have to add that amount that you're short to year two. And now you only have 19 years to amortize that over. And then if you miss it again in year two, you have to add all that shortfall to the amount that you have to put in year three. And that's only amortized over 18 years. So that was a really interesting thing that I got out of that report, that Haas report also, talking about, you know, when you miss your investment target and you have to then, you know, add that amount that you missed to the next year, and you have to divide it over 1 year fewer than what you had before, which is why these UAL payments are going up so exponentially. Member Kerr, you had a comment?
Thanks. I know that we're at 5 o'clock and I don't want to spend the rest of the evening on this agenda topic, but I do have one more line of thinking, and it's in response to Heather's comments about reserve funds being sort of places that you can put money, but you can't get them out again unless you spend them specifically for that purpose. So I want to understand a little bit better, and maybe Heather, you can send me some resources where I can read up more, because it doesn't have to be an education that happens right now. But reserve funds, can they have two purposes? Can they have a time limit where you put them in reserve for 5 years, and if they're not spent for that, then they go back to a general fund? What are the rules of the road, so to speak, on reserve funds, and can we work with that as we look forward to these points where we're going to have to pay CalPERS more money? So just my further comments on that.
That does actually have a really quick answer if you'd like me to go. So reserve funds that are created by council with general fund money can be reallocated at any time. They generally have policies around them. Like we have a fund balance policy for our general fund. We also have a reserve fund policy on how they can be spent and when. But the council can vote at any time to go against those policies if there's an emergency or anything like that. If you put the money in a 115 trust, then you can't do anything with it. It is for pension at all time. You cannot revoke that.
And there is some benefit to doing that, right? Because if this reserve fund is set up with all good intentions of, okay, we're going to use this to smooth out our UAL payments over time. But then 8 years from now, council may be composed of entirely different members, and they may have different priorities. And while it was set up with the intention of being a reserve fund to pay pension UAL, it could be unallocated and reallocated to something else. So that's the downside of not putting it into either a Section 115 trust or just paying it to CalPERS. If you do either one of those two actions, then it's definitely pension money. But you know, it's a double-edged sword. If you allow yourself the flexibility to do what you want with it, someone at some later point in time, 8 years from now, could decide to spend it on something totally different. So, okay, why don't we wrap up this topic, and I'll create an appendix to that memo that lists out all the data points, and I'll send that to Heather for inclusion for our November meeting. And then I think we should, I don't know how we, you know, move this idea forward of a reserve fund, or if we even think that's something that we want. Do we want to table it for now and everyone thinks about it and we come back at the November meeting and decide whether we'd be in favor of recommending starting a reserve fund?
I would be willing to make a motion that this report be part of our work plan presentation to council as it is now with your amendments. So I think that may be your intention anyway. But if we need a motion for that from tonight's agenda item, I'm happy to make that motion.
I will admit, I have no idea if you need a motion for that. I don't think so.
Okay.
Okay, so I'll just attach this to the work plan memo. I think then at this point, it's probably time to take public comment, and then we'll move on to the next agenda item.
We'll give a second for hands.
Well, I'm still a little, so we're going to be just submitting this to the council as part of our work plan, but without any, I mean, we should request a feedback from them. I mean, just send it to them and hear what they have to think. So it would be good to give a recommendation. So I would favor including a single recommendation regarding this, so they have something to respond to. They don't, I mean, we're not trying to get them to, make a, and that's what they want from us, is some ideas.
And there is the unallocated surplus from the last fiscal year that we could make a recommendation to spend, some amount of that on the UAL, or to set up a special reserve fund for this.
Right.
And if we decided to set it aside as a reserve fund, it definitely gives the flexibility, right, that it could be unallocated and reallocated to capital purposes or something else. So I would be looking for some sort of a recommendation, for how we want to present this. So I'll present this to council, and then we give them a recommendation. And so is it just fund the pension, send it to CalPERS, or set up a reserve? Mark?
My feeling is, since we're in the middle of talking or looking to hire an investment manager, maybe we should just hold off, see what the investment manager, see what we choose, see how we feel about it, and maybe revisit this in 6 months or 9 months. I mean, we have the flexibility. If we put it in a fund, we always have the flexibility of sending it over to CalPERS, right?
Mm-hmm.
I mean, we would lose a couple % of what we, need to pay CalPERS, but that would be my recommendation, is to hold on until we've really sussed this out with our investment advisor, who we're in the process of hiring.
When does that surplus, when do we need to decide what gets done with that surplus, Heather, from fiscal 22?
Never. So fiscal year 22, I don't actually know yet. That I generally will bring suggestions for the finalized, here's what the surplus is, I try not to say, here's what your surplus is. I say, here's your fund balance. Here's your 25%. Like, here's your general fund balance at the end of the year. Here's your 25%. Here's what's budgeted for covering the current year deficit. And then this is what's left over. And so it's often referred to as a surplus, but sometimes that gets interchanged with how much money is left over from revenues minus expenses in any given year. So I try to, especially where we're budgeting deficits, I'm trying to pull away from saying we're reallocating the surplus to saying we're reallocating any excess general fund reserves. I guess that's neither here nor there. But I bring that to council when we present the audit and with suggestions. And so it will come to you before it goes to council this year, when we get the finalized audit in hopefully December. So your February meeting, it would go to it would come to you, and then we'd go to council.
Okay, so I guess we're going to present this report without further recommendation at this time, and then we'll wait and see. We'll have a lot more information in November once we get the audit. We know what the real numbers are, and maybe we will have chosen an investment firm by then, or narrowed it down or something.
And we do have one public comment now if we want to
Okay, let's take
circle back to that.
public comment then.
Okay.
Yes, this is Gregory Bone calling in. Can you hear me?
Yep.
Oh, thank you. I had a little difficulty signing in, so I've been watching and now I've established a good link. So I'll be very brief. Can you still hear me?
Yes.
I'm sorry, I've lost you on the screen. I wanted just to comment, thank you for that really excellent subcommittee report you authored on 726, 3 pages. I mean, it lays everything out very concisely, and it's just really what was, I think, needed. A very easy read, very direct, and it states the problem very succinctly. So thank you for that. I also submit a written comment. I want to really thank Heather Rowden for doing such a good cleanup on the city documents, the budget financial documents. There was an issue I looked at back in 2016. I wanted a number, and it gave me a chance to look at the documents back then as opposed to what you're seeing now. And there's just a world of different, much more professional, logical, well presented. So thank you for that to the finance director. Also, just generally, thank you for just stepping up in the breach here. It's a difficult job, thankless. I don't think you're getting a paycheck for this. In fact, I'm quite certain. So it's really wonderful to see people volunteering with a sense of civic commitment. So thank you. I think things might be a little different in the future. It could get very, very difficult. I think Member Papilia noted that a couple of meetings ago that you know, things can change, and but I hope everyone treats you all professionally because you are really doing an excellent job, and I see a lot of deliberation, a lot of thought that goes in this. I did send you the policy brief from that was posted on the Haas website from Tom Seguros. I personally found it very fascinating. It seems like the Holy Grail is stated to be full funding, 100%. And this read was really interesting. And it caused me to think about sometimes we all need to, we're going down one path, one road, and maybe it's not so bad to stop and along that path or that road and just kind of rethink things. Are we doing the right thing? Are we not doing the right thing? And the pros and cons. I say this knowing that CalPERS is a shot caller here. But if you really read that policy brief, it paints a lot of dark clouds out there, storms, maybe a tsunami if you want to word it that way. And there might be a point where if this 100% funding sticks, and of course we've shortened the amortization from 30 to 20 years, which is not a bit helpful, you know, it might be something that gets some political impetus to perhaps take another look at this. And I'm not saying change it. That's why I really felt I'd be curious to know what Committee Member Criven and Chair Trainer think about this. These are financial professionals in your committee, and I don't know what I don't know. And it just was interesting to me, and I'm glad you had a chance to look at it. On the 115 trust, yes, it does lock you in from what I have read, but again, as pointed out by Chair Trainer, that cuts both ways. It can be very positive. My view of this CalPERS situation over the years is, you know, it's a political body. It's 13 people appointed by labor, by politicians, by whatever. They define where the members actually come from. And it is a political body. And look how long it's taken them to lower the discount rate. It's been unreasonably high for so long that they'll take votes. And grudgingly, they're now down to, I think, 6.8 at this moment in time. And it probably should be lower. But it's a political body. And as Chair Trainer pointed out, in the future, you'll have different makeups of your very commission and, of course, the City Council. And I think one of the benefits of a 115 trust that I can see at this point in time is that it takes too much as possible the political shifting winds out of this possible partial solution here. And it does give you perhaps some flexibility on how you handle this money separate and apart from simply giving to CalPERS. They aren't meeting their mark, and they haven't been for a long time. They've been slow in recognizing it. And as Member Criven pointed out, you know, this really isn't the city's problem. it's, you know, we're with CalPERS now. And the point I would say is, I think at this point, the tail is wagging the dog being the city of Albany, the tail being CalPERS and CalPERS investment returns. And I think this is not a good situation, but this is where we find ourselves, and any solution you can come up with is extremely helpful. Maybe look at the 115 for the reasons I've just expressed. But thank you for doing what you're doing. Thank you for reading a few things I've sent you, and particularly the Tom Seguros policy brief. I thought that was very interesting, and maybe we keep that in the back pocket for a while. Again, thank you to everyone for serving, and I appreciate the time. Thank you. Good night.
Thank you for that comment. I think we have one more public comment. Is that right?
Yeah, good evening. This is Jeremiah. I was just wondering what the chances are the city hiring, you know, an investor, a stock investor, get some good input. I mean, I know personally, I've made a lot of money in stocks on short sale. I mean, I bought Tesla Exploration when it was only 15 cents a share. I bought 10,000 shares. And then the next day it went up to $7. So it's pretty much $500,000 overnight. And I just think the city is missing out on a lot of opportunities for, you know, investing in the stock market. I know a couple private companies that do investing, stock market investing. These people are really smart. I mean, these people make over $10 million a year. Got fancy houses in Lake Tahoe. I was just in Lake Tahoe over the weekend myself, you know, so I don't know. Risks, you know, take a certain percentage, maybe 5% or 10%, and invest it in high risk and take a chance. But, you know, these low percentage APR, APY, 3%, 6%, 12%, it's just kind of, it's not even really paying taxes. You know, taxes is 10%. So it's not even breaking the tax barrier, but just please explore your options. There's a lot of opportunity out there. Thank you.
Great. Thank you for your comment. Okay, I think that concludes the public comments on section 6.2 of the agenda. And I'd like to move on to item 6-3, which is the work plan item regarding revenue enhancements. And I believe the revenue subcommittee, which is Member Kerr and Member Papalia, have a report to present.
Thank you. And I'm going to confess that I am not able to share my screen and wonder if someone else could share the screen and just possibly scroll for me so that we can, Member Papalia and I can move through this report as quickly as possible. Chair Trainer, could you do that for me? Thank you. I promise to learn how to do this.
All right, so here we go. Right.
So rather than walk you through the entire report, because we have really covered a great deal of this in July 26, this is a July 26 dated July 26 report, but it does include updates since that time. I'd like to just kind of go through page by page. The vacancy residential tax has been tabled currently by the council. If it comes back, we can continue to discuss it and maybe make some recommendations to council. But at this point, it is not an item that I would expect the council to do anything other than recognize it was part of our work plan. So if we could go to item 2.
Sorry.
It's all right. I appreciate your.
Oh, here we go. Let's do it this way.
Yeah. The electronic billboard is there's nothing new on that item. And I would defer item number 3 to Member Papalia. This was his item, and I think we're pretty much in the same place. This will be on the ballot, but go ahead, Francesco.
Okay, yes. So I've actually been seeing a lot of ads on the ballot for this ballot measures 26 and 27. And we may not be able to do much about it until we see what happens, because they will very, very different the way they affect the city of Albany, because one would allow sports betting at Golden Gate Fields and the other would not. And so it was more if the ballot measure that allowed sports betting at Golden Gate Fields, how we could be able to, how that might affect revenue stream here, and whether there could be kind of a tax, our share of that could be produced. Item 4, that's been an ongoing issue where we're trying to find out from the university and the local tax, Alameda County tax assessor, what's being paid and what against what kind of assessed value. I wish we could get more information about this. I think it would be important that we ask the council to provide direction on this and assistance, because I don't think we can get very far on our own about this at all without better assistance higher up the food chain. Item 5, the local tax on marijuana dispensary. I think that is definitely worth looking into, just to see whether it's could be a possibility. My understanding, and I still haven't been unable to get an answer from the state, whether we have been losing shared revenue stream from the state tax because we did not allow dispensaries. But my understanding is that the moratorium that we put on it may have expired. I don't know if anyone has applied. Has that affected what we could be receiving? But my experience with the California Cannabis Board has been not very open, and they just seem to be too busy to respond to us. We need some help from council, if that's possible.
If I could, Member Papalia, just kind of chime in a little bit here. While we may not know what we're losing from the state, we do know we're not taxing any sales that happen locally, and many jurisdictions, municipalities have local taxes on marijuana dispensaries, which are revenues that go directly into their general funds. So there may be a cut from the state that we're missing, but we're definitely not collecting any sales tax because we're not allowing any sales. So. Right. So I'll take the next 2 if that's okay. Item 6 has been rolled up into item 4. Item 7 is a progressive real estate transfer tax. There's really, like the previous, there's really not a whole lot new on this. I have had some conversations with community members about how this progressive real estate tax could be made more possibly policy driven. It already does sort of address the issue of income disparity and creates a sliding scale, if you will, of income. But there's also ways to tie the real estate funds that are collected to specific programs. It's possible that the money we collect from the 2.5% on the properties over 2.5 million could feed back into a housing fund for low-income housing in the city. So there's a number of ways to approach this. It will be up to the council to decide whether they want to pursue this, but it is one of our recommendations at this point. Item number 8 is neighborhood parking permits, and there's nothing new on that. Business tax, 8 and 9, business tax license revision for potential revenue depends on format proposed. And this item has also been tabled, so it will be in our report, but it is not something that we're actively working on. And then item number 10, which is a new item in this report, review current policy for fee waivers to planning department. Consider removing fee waivers for solar installation and earthquake retrofits. So I did have a conversation with the planning department, with a person in the planning department about ways in which we are currently incentivizing people, but that incentivizing comes at a cost. And apparently, based on information that I had in the conversation, there's a pretty significant, well, it's not a huge amount of money, but there's some money that could be gained if we simply remove the incentive for solar, which is already fairly popular, and the people who are installing solar have a fair amount of money, so possibly they could afford to pay the small permit fees that are actually happening, that are being waived currently. And is there an item 11? Let's find out. There is a new item that Member Papaglia and I have talked about briefly, and that is consider a ballot measure to create tax requirements for private commercial residential properties that do not provide earthquake retrofit or solar power options. So this is the carrot and the stick. This is more a stick, sort of a punitive kind of way. But there are a number of commercial and residential properties in Albany that do not have sufficient earthquake retrofit and haven't got solar power. So we could disincentivize or create a negative tax that would be, again, what happened with the money or the revenue that was generated in this way could be part of how any kind of ballot measure would be written. So that's the end of our recommendations, and that will be what we will talk to council when we present our work plan. So anyone who has any thoughts about whether we should we edit it further? Should we just leave it as it is? We're happy to hear any recommendations from the public or from the commissioners. Thank you. I'm sorry, Member Papaglia, do you have any further comments?
Yeah, so I also want to give some additional information. So there is a new ballot measure, the EMT ballot measure, that could provide a $700,000 cure of a current shortfall that we have to make up from the general fund for EMT services. So if that passes, that could provide, doesn't provide more money, it closes a shortfall. Now, we did pass a utility users tax over a year ago. Unfortunately, for some reason, the county is slow in assessing that tax. And so even though we passed it in the past, we are not collecting any money. And my understanding is that in the tax year 2023-2024, that utility users tax, which we'll all be paying for our use of the utilities, could bring an additional $800,000. So those two measures, one if one passes and the other when it goes into effect, could be bringing in approximately $1.5 million to cover our budget deficit.
Oh, would that utility users tax be general fund money?
I don't know. Probably.
Do you know about that, Heather?
Are you talking about the utility users tax increase that was passed in 2020?
Yes.
That's a city tax. It's not a county tax, and we are collecting it. It is a general fund tax. It was passed with a caveat that voters encourage the council to spend 1/3 of the increase on climate action plan items. And so that has been something that we're working on. We had an issue implementing the tax with East Bay Mud because in addition to increasing the utility users tax on gas and electric, the tax was extended to water. We have started East Bay Mud has started collecting the tax now.
Well, maybe that, and how significant is that?
$300,000, something like that.
Okay.
So was that part of the collections for the year that just ended then?
They started collecting the tax in October of 21, if I remember correctly. So yes, I have not presented the year-end quarterly update yet. I plan on doing that at your next meeting.
Right. So this actually brings into focus something that I think is essential for us to understand more completely so we can provide better recommendations, is that, Heather, can you pull up the fiscal year 2022 third quarter update, please? You just need page 1. And I've discussed this in the past. And this is where we have, I'll see if you can, where the revenue streams that show our revenues year over year, quarter over quarter, are the property tax is one figure for that's $8 million, like for 2019. I'm just going to go down 2019. The sales and use tax is 4.2 million. The franchise and other taxes is 4.9, and the current service charges is 1.1. And particularly when it comes to, thank you, in trying to understand our budget deficits going forward, I think it's essential that those numbers that are over $1 million that may have be somehow broken down on following pages and individually in some respect, but it's, you know, it's indecipherable in terms of judging how we're doing. And we understood that the property tax revenue that we received from the transfer tax was basically what we've been surviving with surpluses for the last 2 years because of the increase in the transfer tax, the increase in property values, and the increase in number of sales that provided I believe, at least $1 million unbudgeted surplus that basically covered the what was negative in the other sales and use, franchise, and other taxes. So whether you provide it for as part of these update, I believe that the revenue subcommittee needs those numbers broken down in a way, in a table format, year over year, so that we understand what's doing well and what isn't. I still do my best to shop at Bevmo to buy my liquor and wine, and go to Target to get what I need through Target. And I go to Safeway and I go to CVS on Solano for the sales tax that we are charged. And I know that certain people actually leave the city and want to go to El Cerrito or Richmond or Berkeley to save on sales tax or other kinds of things. Well, we need to show the public where our sales tax comes from. And, I would personally would like to be able to propose a Shop Albany program and to show the public how it will cover our budgets that we're going to be needing that money coming from to cover it. So is there a way, Heather, that either the revenue subcommittee can get those year-over-year breakdowns of those $1 million plus items on the revenue side?
Yes, those can be provided.
Okay. Great.
So I guess at this point, we should talk about any suggested edits to the proposal before it goes to the council. Really like how that's all laid out with all of the various items. And my one comment would be maybe prioritize the things that are still possible, because I know some of the items on there have been tabled for future discussion, and maybe those could go to a separate section at the bottom. Just have the ones listed at the top that we would really, like to explore further or, make proposals about.
Member Papalia, I'd be fine making those changes. The only concern I would have would be, should we bring it back, or can we make those changes and just flip things around and still have it be presented in time? Do we have to have another agenda item to look at it again, which would not be my preference? I would just like to make the changes.
I think it's essential that we send them, we can send them the whole report, but ask for direction in particular on 2 or 3 items. And okay. Like the dispensary and which I think could, I would love to hear what they're thinking about it. Okay.
Okay.
So that's the kind of thing that's important to understand, whether there's any interest in the council in doing that. I think I also would recommend the graduated transfer tax.
Mm-hmm.
And maybe one other, is there another one that you would like them to look at?
I'm happy to hear from other committee members, commission members as well.
Can I?
Yeah, Member Previn, go ahead.
Yeah, so so I think the ones that you are going to request really help from the city. I know the one where you were frustrated in terms of not being able to understand or not get the information on what property tax is being paid by Belmont Village and UC in general.
Okay.
I would highlight that one. And just a small comment on that one. I think when we were going through the financials, I think Chair Trainer was pointed that somewhere in the back there was some kind of valuations. I don't know if that was helpful or not, but it did ring a bell when we went through it today.
Okay.
I also really like that idea about the electronic billboard. It just seems like it has minimal impact. I guess the people that live on the hill might disagree about that, but that one seemed to have kind of a lot of potential revenue for not having to really do much to get it.
Okay, great. All right, I will reformulate and I will send it to Heather and we can go from there.
Well, public comment?
Run it by you too. Member Papalia, the subcommittee will do it together.
Yeah, we should get.
You want to type? I'll type. All right.
Okay, so you'll reformulate that, and then did we decide that you're just going to go ahead and are we going to look at this again in November or no? Okay.
When are you going to report to council? Is that December? I've lost track.
So that is for their December meeting, and that's the next agenda item. So maybe we should
I can bring it back. We can look at it again.
I think it could be a very quick discussion at the November meeting. We've reprioritized the UC tax issue and the billboards and the other couple of items that were mentioned, and then all the other things that have been pushed back to a future year are maybe just in a completely separate section of just things to consider in the future or something.
Spaghetti on the wall. Yep. Okay.
Okay. So we'll have a final version of that, and that'll be a quick agenda, hopefully, point for the November meeting. So can we go to get public comment on this agenda item? Looks like 2 people have their hands up.
Jeremiah. Yeah, so as far as I know about the UCs, is that any college or UC in California doesn't have to pay property taxes. But maybe there could be some sort of other way they pay something, ask them politely to help donate a fire truck to the fire department or do something. I know the fire department responds to calls in the UC, and the fire department doesn't even get paid for those calls. And the UC Village accounts for 1/3 of their calls. So another thing is that, money is money, revenue is revenue. However, the city could generate income to go towards the budget would be great. So my question is there a job within city staff that a staff member applies for state and federal grants all day, 8 hours a day, 5 days a week? Because I've looked up online and there's so many grants available. There's so many different things available that I just don't think the city's applying for. Also, when the city buys stuff, the city gets a city discount. If you buy things from Target or Staples, mention that, your city, you're a government municipality, you get a discount. I know I did a quote for porta potties to see what a porta potty company would rent porta potties for or even sell them to the city. And they said they would even give the city a discount to buy porta potties because they are a city, they're a government. So anything the city buys, make sure to give yourself some props and throw out that you're a city and give you a discount. So yeah, so basically my question is, is there a budget to at least hire somebody that sits in the city hall and applies for grants, state grants, federal grants, all day, every day?
Okay, thanks for that comments. And is there one other comment? Okay, so there's one other public comment.
Yes, I'm Gregory Bone again. Thank you for making progress on the revenue enhancement side of the equation. I kind of know the cost-cutting side. As you know, I worked for the police department for many, many years. I'm very familiar with that. I know what it can do, but I also know the limitations of that. And I think I've indicated in my comments or suggestions to you that I think the bulk of the solution here probably lies in the revenue enhancement side. So thank you for that subcommittee's good work in that area. And that's all I have to say. Thank you.
All right. Great. Okay. Thank you for that comment. So I think that concludes the discussion of item 6.3, revenue enhancements. And so on the agenda, we're going to move to our last agenda item, which is 6.4, the work plan update for council. So we have our finalized work plan, and there are various required reporting items for the work plan. The reporting period will be the first year of the Financial Advisory Committee, so the year that concluded on June 30th, 22. And we'll be reporting to the full council in their December meeting. So we need to start drafting our report. And I thought what I should do at this point is share the work plan to my screen so that we could sort of look at this together and talk about how we're going to do this. We've talked about pieces of this throughout this meeting. And so here's our finalized approved work plan. And this is where all the required items are. So there's regular reporting, year-to-date budget versus actual, report on audited financial statements, pension funding. That one's desired. The first two, it says it's required. And so I guess my first question is,
can you make it a little? Can you make it a little bigger?
A little bigger, okay.
Yeah.
Like that. Oops. Okay. So there are regular reports, there are recurring action items. And then was there, yeah, that's basically it. So the year-to-date budget to actual reports and the report on the audited financial statements. So those were items that Heather presented to us at some of our meetings. The budget versus actual reports are sort of on a quarterly basis. So I guess my question is Heather, what are we required to do here? I mean, you've reported to us, we've asked questions.
So I think what the intention is for the Financial Advisory Committee to come back and say if in reviewing these things you had any suggestions for changes or requests for additional information or anything like that, or if you see trends that you think need to be addressed, things like that.
Okay. Okay. Then, all right, so there are those two items. There's the pension funding overview. So I'll give them that report that Mark and I put together for that component of the work plan reporting. And then there are all these recurring action items. And everywhere where it says required here, I'm assuming that we need to make a comment about these work plan items. So the committee will review and report to council on a biannual basis non-administrative finance policies and practices. I don't think we've ever discussed that, have we?
I don't think we have, but I can bring those to the next meeting if you'd like.
I guess we need to non-administrative finance policies and practices. What does that even?
So these are the fund balance policy that I was referring to. These are policies that are passed by council. So for financial purposes, I think there's 3 or 4. There's the general fund balance policy. There's the reserve fund policy. There is purchasing policy that is in the council administrative policies. So I can bring a report next time about what those are.
Okay, that would be helpful. Then we'll also review and report to council the biannual budget. The report will accompany the biannual budget. And on that one, and I think this is going to get into another comment that several of us have made, basically, due to the fact that we've really only been meeting on a quarterly basis in the first year, we reviewed things after they went to council. So there wasn't really the option for us to say, here are our comments on the biannual budget, because we saw them after they had already been to council. So that to me is kind of a backwards approach to that. And I think we need to consider meeting more frequently so that we have enough meetings so that we can review things like the budget before they go to council. So I guess part of this work plan report, I think, needs to be a discussion of how frequently should this committee meet. And do we really need to be meeting more often in order to be able to accomplish all these things and review things like the budget and the audit before they go to the council, because I think that is the right order. So just want to open this up for your comments on the question of the frequency and, you know, how to basically solve this problem of, you know, the financial advisory committee really should see the budget and the audit and things like that, so we can make recommendations to council. Does anybody have thoughts on the meeting frequency thing? I thought that was something that could be included in the work plan reporting. Oh, Member Papalia.
Well, I see 2 other hands up.
Oh, no, I see 2 more as well.
I think I was last.
Okay, I'm not sure who was first because I was sharing my screen. Member Papalia, do you want to go first? And then we'll take Member Kerr and then Vice Chair Priven.
Okay. I completely agree about our meetings. And I just have a little statement here that I prepared. It says, I think that we should increase the number of meetings per year from 4 to 8 so as to include an extra meeting before the presentation of the quarterly budget and investment updates, and provide ample time for the committee to work on specific revenue, expense, pension, and investment portfolio strategies. I think that would give us 2 things. It would give us a kind of regularity. I apologize for doubling the workload in a sense. I joined this committee specifically because it said 4 times a year. And I said, I could do that. Well, the problem is I don't think we can do that in 4 times a year. And I'm actually interested and excited about stuff now. I'm just getting the hang of it, you know, of all these different numbers, thankfully, because of great reports and work by my fellow committee members here. The other thing is that what it would do, by going from 4 to 8, is that there's a kind of momentum that gets lost when is it going to be 3-4 months? Is it, you know, and we've been shifting the dates around and the times. I think that it would keep myself more tuned up, closely tuned, and to stay on top of things and keep it fresh in my mind. Thank you.
Thanks for that recommendation. And I liked your statement that you wrote about that. Would it be possible could you send that to Heather so that could be included in our next meeting? And I'm thinking, you know, assuming whatever edits we need to make, I might be able to copy and paste that into our report. Member Kerr.
Yeah, I echo Member Papalia's comments, and 8 times a year might be enough. I actually think, looking at the work plan, I wanted to just underscore that what's required and what's recommended or suggested be reported on is somewhat arbitrary. It was, I mean, when you and I, Member Trainer, as the vice chair, when I was chair, wrote the work plan, we were asked to assign those designations, but they weren't necessarily well thought. We didn't know what our committee was going to be doing, what the commission would be about. So I think that if we feel that something is more important, for instance, unfunded liabilities and revenue, that can certainly be part of a work plan change, and we may want to do that. But implicit in all of these things is when something is required and you know how many minutes it takes to give a report, I mean, there's an equation that you can build from the work plan and how many meetings we have to have a year. So whether it's 8 or whether it's 6 or whether it's 10, we probably could assume that a quarterly budget report takes a minimum of 30 minutes, possibly an hour with discussion, and then, you know, do the calculation of how many meetings we actually need. Because meetings are not just our time, they're staff time and their public involvement time and ability of public to participate in more meetings. So I think we just need to be mindful of that. That's it. Thanks.
Thank you. I think that does really factor in, I didn't articulate it as clearly as Francesco did, but I was thinking, there are the quarterly reports that we have to go over, but then there's the audit, there's the budget, there are, revenue and pension subcommittees. So, I mean, just those things are 4 things in addition to the audit reports, right? That necessitate a little bit more time for discussion. Vice Chair Priven, do you want to make your comments?
Yeah, I took my hand down because I agree with what was already previously said.
Okay. Member Panzer, we haven't heard from you, and this would impact you, obviously, because we're talking about increasing the frequency of these meetings. What are your thoughts on this?
I'm also in agreement. I think, I'm still sort of getting we're responsible for, and it's a lot. So, just the first 2 meetings, bumping up against time constraints as it is. So yeah, I'm definitely, upping our yearly meetings up to, I think 8's probably, maybe even monthly. I mean, that's maybe a little bit more often than everyone wants to commit to, but we could probably spend that time productively getting these things done. So I'm for increasing, and I'm sort of flexible about what that looks like for everybody. And
Okay, great. I think 8 is a nice compromise as a midpoint between 4 to 12, and that would certainly be reasonable in my estimation, and it could always be revisited again later. So, all right, and
Quick point, please.
Mhm.
First, just so we understand, there is no 12, there's 11, because August, there's no meetings.
Right.
So we're considering whether it's 8 or 10, 8, 9, 10, 11. So, and the other thing is that I think we learned a lot in this last year and a half. And I think, a lot of my questions got answered, and we may be able to, handle things a little more succinctly, but with just twice as much time.
Yeah.
So, and I think that would be an easier thing to be able to get to the council and get approved sooner rather than later. I mean, I almost wish we could get that to them before our November meeting or something like that.
Okay. I agree on your point about, I think we're going to probably proceed more efficiently as we hear the quarterly reports and review audit and budget, because we have learned a lot in this first year, and a lot of the questions, I always go back through my notes before these meetings and try to remember what's general fund and what's special reserve and this and that and everything, and try to bring myself back up to speed so we don't have to do it in the meetings. And I think we will be able to move, more expeditiously as we go forward and get a little bit more done. So if Francesco, if you would just submit your statement to Heather so that we could include that in the record of the next meeting, and we'll add it. I'll plan to add that as part of the examination of the reporting on the work plan. I'm just going to go back to that screen for a minute because there are a lot of required reports on here, and it really sounds like a big task to come up with this report. And so it seems to me that it makes sense so Mark and I could handle the pension related reporting. Obviously, the revenue program reporting seems like that would make sense to come from members Kerr and Papalia. So that would take the form of your report, and if there's anything else that, like a narrative that you want to have as a cover sheet for that or something, that could be put into the report. Then there are just a lot of other items on here to respond to things. So I'm honestly feeling a little intimidated looking at this and the amount of reporting that needs to come out of this. So other than the obvious pension and revenue reporting, I don't know what's the best way to, come up with this thing. I'm happy to start a draft, and what I guess what I would ask is if I could, I'm not sure how we do this, right? I'd like to be able to reach out to the committee for comments on different things. But then if we don't do it during a public meeting, we can't do that.
That's right.
So then it just becomes, well, Kim is just like, reporting her own opinion on all these different work plan items. So how do we solve that problem, Heather?
So I have one suggestion on both the investment policy and the biennial budget. I wouldn't necessarily include that in your work plan update to council. Not investment, but all the financial policies that council approves are put into the biennial budget package now. So you could actually, as a committee, submit a memo when we bring forward the biennial budget for those two items. And that kind of gets them off of your work plan update thing right now.
Okay.
What I would suggest for your presentation to council is your next meeting is in November. I would suggest Chair Trainer and someone else work together to develop a memo and attach your the subcommittee reports that you want to present to council. You can put that agenda item on your November meeting, and then you can review it together then before it's presented to council.
Mm-hmm.
I'd like to do that.
I'm sorry, I didn't see that. Who said that?
I did. I would like to, that way we have someone from each subcommittee in a sense.
Right, okay.
And I won't talk to Judy anymore until then, till I've talked with you, okay? So,
I have a question for Heather. Heather, is there a template for reports to, or is it reiterating?
Judy, we can't hear you very well.
So I did understand the question though. I reached out to a handful of other people. There's really no template. Each sub or each commission committee, whatever, sort of does their own thing. Some do a PowerPoint, some, something more formal. So it's whatever you guys want to do.
Okay. All right. So, Francesco, we could have a meeting, just the two of us, where we sort of try to hammer out a draft, or alternatively, we could just both write some stuff up and I just put it all in one big jumble. What's your preference?
I'd like to have a meeting.
Okay, yeah, I think that
I have enough virtual in my life.
Okay, I'll reach out to you separately to
Okay.
to meet, and we will put together a rough draft of this report for the November agenda, and then we'll talk about it there, get any of your feedback, and then come up with the final for the December council meeting.
Okay, so then before we do that, it would be nice if we could go around the committee and each person, if they can, just say one thing that they might want to give us as input to that, repeating something else that they've already, just so that this is their opportunity for the other three members to say something out loud and for us to take in that doesn't violate the Brown Act.
Yeah, that's a great idea. I'll put this back on the screen so here's your, I think these were kind of know what we're doing, but then there are these recurring actions down here.
I don't think I understand the ask.
Is there anything in particular is when Kim and I rework the work plan that you would like us to incorporate? Something that you may have already said or something that just occurs to you that
I guess the thing that occurs to me is as we have an investment advisor, are we doing any sort of interaction or oversight with them or review of the investment policies? Maybe that included in the non-administrative financial policies. I don't know.
okay.
So that would be this one here where we will review and report to council on a biannual basis, non-administrative finance policies and practices.
But I mean, also, as we have a financial advisor, are we helping to evaluate their performance over time or anything like that? I don't know.
It goes back to what I think that is part of what was the call for the request for proposals.
Mm-hmm.
When they talked about, so we should include what was in, which was in the agenda attachment about picking having two members as advisors, and that it was supposed to, that person would be coming and reporting to us as a committee,
Mm-hmm.
I believe. Isn't that correct, Heather?
I'm sorry, the two people that are sitting on the investment advisor panel, is that what you're asking? Would they be reporting?
In the document, I don't have it in front of me. I didn't print that one out. It said that it recommended that the Financial Advisory Committee choose two people to help with the review of the applicants. But I also thought it said that the financial advisor would be reporting to us.
So
did I misremember that?
I think what is going to happen is once the investment manager is selected, they would provide quarterly updates to the financial advisory committee on how the investments are doing. Yes.
Right. So they'd come to our committee meeting and present. That's
yes,
pretty close interaction.
They will present to you guys. Yes.
Yeah.
So I mean, I guess the possible comment or reporting that could be made would be reporting on something having to do with the selection of the investment advisory firm, right? Because that meeting will most likely take place before we compile this report, right? So there could be some, like Mark, that would be something that you could give us, or Judy, just any comments having to do with the RFP process or the selection of the investment manager, maybe why, you're recommending one over another or something like that. Yeah, so, okay. Significant financial short and long-term issues facing the city. There was that whole state auditors report thing that we talked about several months ago, but haven't really come back to. Does anyone have any comments specifically about any of that? All right. Well, So I think we just need to sit down and take a stab at putting some thoughts on paper. And I know it's a lot easier to react to a report where there are thoughts on paper as opposed to a blank sheet of paper. And that will facilitate conversation. So we'll work on that. And then we need to take public comment on this agenda item. Is there any?
I do not see any hands raised.
Okay, so then that brings us to item number 7, future agenda items. So this is where we can announce requests for future items for the agenda. So anything else other than what we've discussed? All right, the next meeting of this committee will be November 2nd, 7 p.m. And that will be on Zoom as far as we know, right?
If there are any changes, I will reach out ahead of time.
Okay, great. Then I think we've covered everything and we can adjourn this meeting 6:10 p.m.